Okay, what's going on, everyone? So, on today's video, we're going to be talking about trading the news. How do we go about in speculating um, news events, especially the interest rate decision, the FOMC, and NFP. But I'm going to be talking about mostly to make an example on the technical side on how to do the trade on the technical side, rather than to speculate on how the fundamental side works. Let us say this video is going to be the part one of trading the news net. But for now, I'm just going to talk about the technical side and try to do a little explanation on like what is an interest rate decision and what is also the NFP, because like those are the most news events that create a lot of volatility on the markets per se, and they are they are mostly based around the US dollar itself. So I'm doing this video because a lot of people have been asking me about Smoke. Can you please do us another video or a Zoom session based on news events and stuff? So I'm just gonna do this little video. I'm gonna be quick, and if anyone has another inputs, they can add their inputs or they can criticize, but it's okay. But this is my videos are mainly for educational purposes, not trading advice. So when it comes to speculating the news, especially the interest rates decisions, so just to do a quick recap of what is the interest rate decision, or what is the FOMC. So before we move forward, as I said, this video is for educational purposes, not trading advice or anything per se, but it's just for educational purposes. So trading leverage products carries a high level of risk. A trader is liable or either of a portion or their entire loss of margin deposit. So do not trade money you cannot afford to lose. So as I said, that we're gonna focus on the FOMC, and trade. Most people trade the NFP as well, and also they trade the FOMC. So just to do a little description of what is the FOMC. The FOMC, it's just a group of governors in the United States. A group of governors who sits on the board of the Federal Reserve. So it is chaired by this guy, Jerome Powell. Jerome Powell is the chairman of the Fed, and they are basically 12 Federal Reserve banks across the United States. So there's the Boston Fed, the New York Fed, the Philadelphia Fed, the Richmond Fed, the Atlanta Fed, the Dallas, Kansas City, Minnesota, and also the San Francisco, the Atlanta Fed, and also the St. Louis Fed, and the Chicago Fed. So the ones that are mainly most important are the ones that are here. The New York Fed is the most important one, because that's where most of the finance happens in the United States, on this side. And also the San Francisco Fed, it is also important because this side of the United States is populous very much, because California is the most populous state in the United States, and it is the most richest state in the US. it's populous, and also it is the most richest state when it comes to GDP and its own economy. In fact, California can just stand alone and be a country on its own because it's just huge and massive. It has a massive population, and as well it has a massive GDP, followed by the Dallas Fed, which is there in Texas. You all know that Texas is rich in oil. There's the Gulf of Mexico there, where like they dig oil, they drill oil throughout. It's been years since they've been drilling oil. Okay, so the FOMC, guys, it just stands for the Federal Open Markets Committee. Ne? So it's a group of governors, as we said, about 13 or 14 governors sit there on the board. They decide what they think the US economy will do, maybe in the next quarter, in the next 6 months, or in a projection of years, if you can say in that way. So the trading itself, ne? So how do we trade this thing? Ne? Okay, so there's basically two versions of this, of how one can actually try to speculate on this thing. Ne? So when the Federal Reserve is hawkish or it's dovish, it means that if it's hawkish, it means that it is positive for the currency of the country. Ne? So when it's positive, it slows the economic growth and prevents excessive inflation when the Fed is hawkishness. So it gives a strong sentiment, so it prevents a higher inflation, right? And a dovish statement, it is negative for the currency, so it means a weaker statement, so it's also negative for the US dollar. So it stimulates economic growth. A weaker dollar it stimulates economic growth, but it also prevents excessive deflation. You see, a hawkish statement, excessive inflation. A dovish statement prevents excessive deflation. So if the Fed is dovish, the stock markets tend to go higher, and if it's hawkish, the stock markets tend to go down because the dollar just becomes extremely strong. So as we said, there's the news, let's say the NFP or the FOMC rate decision, it's mainly based on dollar pairs. So you can trade these news based on the US dollar pairs alone, as much as the market can move as a whole, but you can maybe just try to speculate on the US dollar alone. So as you see that these are the major currency pairs, which is Euro USD and GBP USD, US dollar JPY, USD CHF, USD CAD, Aussie dollar, and as well as NZD USD. So as we said, that it's mainly based on US dollar pairs. Okay, right. So as we continue, so for trading, the news release can be very profitable, but it is not for the faint-hearted. This is because speculating on the direction of a given currency pair upon the release can be very dangerous. As I said, not everyone can speculate on this. So fortunately, it is possible to wait for the wild rate swing to subside. Then a trader can attempt to capitalize on the real market move. So you can there's two ways to do this thing. You can wait for the major move to die down and then try to speculate after, or you can jump in before the major move. But it's very dangerous for your account to try and jump in on the major move when the move is actually starting. Like maybe you just want to jump in 5 minutes before the move happens, you can win, but at the same time you can lose a lot of money in it. So it's better to wait for it to die down. So when it dies down, you can try to maybe to jump in on it and then make some money there. Okay, so moving forward, the strategy then, because everything needs a strategy. So a strategy, you need to have an idea, you need to be creative, and you need to plan your strategy, and also you need to have a goal for your strategy, and also a solution and a plan B as well when things are not going very well for you. So the strategy here, the logic behind this strategy is to wait for the market to digest the information significance, right? So on this strategy, what we do is that we enter after the move has happened, the big move has happened, and then we wait for the market to die down, and then we try to enter it. So after the initial swing have occurred, and after the market participants have had a bit of time to reflect on what the number means, they will enter the trade in the direction of the dominant momentum. So when the momentum of the market is dominating, we just follow what the big momentum is actually doing. So as we said, that the strategy mainly works on dollar pairs. So for example, I'm gonna make an example with Euro USD. It can be any dollar pair, but since Euro dollar, everybody knows about Euro USD. So let's just rather make an example with Euro USD. Okay. Ama rules rules. There are just 4 rules now, which are very important. Only 4 rules which are very, very important, but you have to remember them, each and every one of them. You have to remember them. So the strategy can be traded off a 5 minute or a 15-minute chart. For the rules of the example below, a 15-minute chart will be used for argument's sake. We're just gonna use a 15-minute chart because a 5-minute chart, there's too much volatility there. So perhaps a 15-minute chart can show us a bit more of data, if I can say. So the same rules may apply to a 5-minute chart. Signals may appear in different time frames, so stick to one or another. Don't just try to change a time frame. So okay, moving forward. Rule number 1, nothing is done during the first bar of the NFP or the FOMC. So depending on the news event you are doing. So today we said it's either we are doing the NFP or the FOMC. So nothing is done on the first bar. You wait for that candle to come in, and then you just wait for it to let it do its thing. And then the second bar is going to be created. Rule number 2. It's going to be created. Let's say the first bar came in at 14:30. So the time I did this presentation, the NFP used to come at 14:30. So times change. So it can either be 14:30 or 13:30. I'm talking about South African time, South African Standard Time. So let's say the bar comes at 14:30. You wait for the first bar to come. Let us do it like this. So this is the 14:30 bar. Let us do it like this. This is the 14:30 candle. Let us assume that this candlestick is green. Let us assume this candlestick is green. Why we're assuming it's green? Let's say the market is actually going higher on itself, and then this candlestick comes. All right, this candlestick, it's the first initial news candle bar, right? You wait for it to open and close. It does its high and then it does its low, but wait for it to open and close, ne? Right? Wait for it to open and close, right? And then the second bar that's going to come in at 14:45, right? So we said this one is at a 14:30 South African time. So assuming that you are doing the NFP there, so the second bar it comes, ne? It has to form an inside bar. So what is an inside bar? An inside bar, the high and the low of that bar has to be inside the high and the low of the previous candlestick. I think that is just straightforward. Let us wait a bit. This thing, okay. So now it's inside bar figure. It forms an inside bar. The inside bar comes like this. Let us assume this candle is bearish, it's red like this. And then the candlestick that's going to break the high or the low of the inside bar, that is our trigger candle. So let us assume the next candle that's going to come is going to be like this, and then it makes a new high from the inside bar. It makes a new high like this from the inside bar. This is our trigger candle. That is our trigger candle. Where now when it does like this, you place a buy order right here. You place a buy order right here. So this is the third bar. This is the third bar. This is the third bar. So let us assume that this was 14:30. This was 14:30, and then it's quarter to, then it's the quarter to 3, and then this is the 3 o'clock candle. This one here. You place your buy order there, and stop loss sakho sibe below the actual news candle. Stop loss sakho sibe below the actual news candle. Usually the initial spike becomes, maybe it's a 30 or 35 pips spike in this. So a 30-point stop loss is not that bad, rather than having a 100-point stop loss. It's gonna be huge. But let's say you placed your buy order right there. Here's your buy order right there. Eventually, irrespective what the market does, maybe it can still come back here like this. It can still come back here like this. This is just an illustration, guys. It can still come back here like this, maybe to correct more orders, but eventually it will go in the direction of the initial move. So the markets might actually continue to go even higher in the direction of the initial move, continuing on its original direction. Remember, guys, this is the news candle. This one is the news candle. The first one is the news candle. The second one is the inside bar. So the inside bar, inside bar asengaba futhi 3 inside bar, but you have to wait for the one that's going to make a high or a low of the inside bar, because this thing can even happen like this. This thing can even happen kanji. Kube inside bar le, but into efike yenzeke yini, the next candle it comes libe kanje, it makes a new low from the inside bar. Kube kanje. Let's say the inside bar is gonna be something like like this, libe green, mhlambe libe green, libe lincane, mhlambe libe green kanje. And then this is our trigger candle. When that's where you place your sell order, right here. You place your sell order on the low of your trigger candle, you enter the market, and then it goes let me say this, 70 to 75% of the time it goes in the direction of the inside bar. So guys, do not kill me when the market does something else, but most of the time it goes in the direction of the what, of the inside bar. So just to make a little example, I saw charts here. It's the previous week's NFP, no? Let us just go on it and see what actually happened there on that day. When was it? Let me see. Okay, NFP came on Friday the 3rd. So let's just go on Friday the 3rd. This was the 2nd, and this was the 3rd. Yes. Remember guys, this is still Euro USD, ne? So it can be any dollar pair, ne? Even USD JPY, it's fine. Friday the 3rd. Yes, yeah, here's the NFP, ne? So this NFP, it came in on Friday the 3rd, ne? But the time here was 15:30 because they've changed their daylight saving thing, ne? So let's come to this candle right here, ne? So this was the spike candle. Look at the time, it was 15:30, ne? The market spiked higher, right? When it spiked higher, what actually did happen, this was the inside bar which formed. You see the high and the low of this candlestick, candlesticks are inside the high and low of the previous candle. Look at what happened. The next candle was, we said, the 3rd candle is the trigger candle, right? And then what happened, it made a new low, and then we post our sell order here, ne? And then stop loss say to let us say our stop was supposed to be maybe here, ne, at this top, because right there it was too far. And then the market, it did go in our direction for let me see 1289, and then that was 12.7. That's about 20 points. Okay, it didn't move that much, but I'm just trying to make an example of what actually happens on this type of trades. As I said, that also the data target, it comes out itself, it also plays a role on what the actual move will actually go. But this is just the technical side of things, of how things actually work out. Even if it's a bearish case, the rules are the same. So let's go over the rules again. Rule number 1, nothing is done on the first bar after the NFP or the FOMC, right? Number 2, the bar created at 14:30, since we are talking about the NFP, but FOMC usually comes out late at night, around about 8 p.m. or 9 p.m. or 9 p.m. depending on the daylight saving thingy. So the first bar, we do not do anything, right? And secondly, And secondly, the inside bar high and low has to be inside the previous high and low of the previous bar. Has to be inside the high and low of the previous bar. And then the third candle has to make a new high or a low. A new high or a low from the inside bar. So that one is our trigger candle, and then after that one you place your order and then you just wait for the market to do its thing. So guys, this is part one. As time goes on, I'll also try to do another video finding other exciting examples based on what you just spoke about here, because this is an ongoing thing, it's an ongoing topic. So I'll do another part, let's say part 2 of this video of trading the news, maybe even with some more data. So I was just making an example because a lot of people have been asking me about this type of trade. So Ukeli stocks 550, the Gentleman's Club, it's 550, only 2 stocks there, but and then for FX and stocks it's 850. So guys, these are just ones of fees. Trading View, it's Sbo Dlamini. Facebook, Interpret Asset Management, and then I have a page on Facebook, Sbo Dlamini, and then on Twitter the business handle, it's Interpret Asset and then my personal handle, which I'm more active on, it's Sbo Dlamini. So remember guys, this is educational content, it's educational material, so we do not trade money you cannot afford to lose. So thank you guys. I'll definitely try and do another video based on this topic specifically, and then we'll just take it from there. So thank you, Bafethu. I'll definitely see you on the next video.